Elon Musk wants to buy Twitter. That's our top story today on The Wall Report. I'm your host, Greta Wall. After declining a seat on the board of directors, Elon Musk has now offered to buy Twitter outright for $43 billion in cash. Twitter shares, though, slipping despite that buyout offer today. A new SEC filing shows Musk offered to buy the company for $54.20 per share. In a letter to Twitter chairman Bret Taylor, Musk said, quote, "I invested in Twitter as I believe in its potential to be the platform for free speech around the globe, and I believe free speech is a societal imperative for a functioning democracy." He said the company will neither thrive nor serve that social imperative in its current form. Twitter needs to be transformed as a private company. Musk said this is his best and final offer, and he will have to consider holding the stock if it is not accepted. And in a statement, Twitter said its board of directors will carefully review the proposal to determine the course of action that it believes is in the best interest of the company and all Twitter stockholders. And the other big story of the day is earnings, and it's all about banks in today's session. Let's start off with Morgan Stanley. Shares rising after strong Q1 results. The bank did report earnings of $2.02 per share on $14.8 billion in revenue. Now that topped analyst expectations on the top and bottom line, and the beat came as trading revenue rose more than expected. Morgan Stanley reported $3.2 billion in equities trading revenue versus $2.7 billion expected, and then fixed income trading revenue did rise to $2.9 billion versus $2.2 billion expected. Next up, Citigroup also reporting strong trading revenue in Q1, which boosted its overall results. The bank reported earnings of $2.02 per share on $19.19 billion in revenue. That was better than analyst expectations for both as well. Earnings, though, were down 46% year over year due to higher expenses and credit costs and lower revenues. Revenue did dip 2% annually. Citigroup is also expected to take the biggest hit of all U.S. banks from the war in Ukraine. The bank has operations in more than 100 countries around the world. Now, Goldman Sachs shares are flat after crushing Q1 expectations. The bank reported earnings of $10.76 per share on $12.93 billion in revenue. That dominated analyst expectations on both the top and bottom line. Now, fixed income, currency, and commodities trading revenue surged 21% from a year earlier to $4.72 billion, which topped analyst expectations. Equities trading revenue, though, did fall 15% year over year to $3.15 billion, but it still beat expectations. And Wells Fargo missed Q1 revenue expectations. The consumer bank reported earnings of 88 cents per share, which did top analyst estimates, but its $17.59 billion in revenue was short of expectations. And that miss came as rising mortgage rates caused a 33% year-over-year decline in home lending. Mortgage banking totaled just $693 million in Q1 versus analyst expectations for $880 million. And it wasn't just banks, though, that reported earnings today. UnitedHealth Group was rallying, but is now flat after a strong Q1 prompted the company to raise its full-year forecast. The largest insurer in the U.S. reporting earnings of $5.49 per share on $80.1 billion in revenue. That topped analyst expectations on both the top and bottom line. And revenue at its pharmacy division, Optum, also rose 19% year over year. UnitedHealth boosted its full-year earnings forecast by 10 cents per share to between $21.20 and $21.70 per share. Now, in the economic news of the day, weekly jobless claims rose more than expected last week. The Labor Department reporting 185,000 Americans filed initial claims for unemployment benefits. That was up 18,000 from the previous week's revised level and higher than expectations for 172,000. Continuing claims did fall, though, by 48,000 to 1.48 million in the week ending April 2nd. Now, retail sales did rise less than expected in March. The Commerce Department reporting that retail sales rose 0.5% to $665.7 billion. That missed economist expectations for a 0.6% gain, and the increase was all thanks to higher gas prices. Gasoline sales surged 8.9% last month. Spending at gas stations was up 37% compared to March of 2021, while spending at restaurants and bars jumped 19.4%. Excluding gas stations, retail sales actually fell 0.3% in March. And February's retail sales were also revised higher to $662.4 billion. And just remember, this data is not adjusted for inflation. Now, meantime, U.S. import prices surged in March as inflation pressures ballooned. The Labor Department's import price index jumping 2.6% last month. That was the strongest monthly gain since April of 2011 and higher than expectations for 2.2%. And that jump came as petroleum prices surged more than 16%. Import prices, meantime, skyrocketed 12.5% year over year, which is the strongest annual gain since September of 2011. Consumer sentiment, though, did rise unexpectedly this month. The University of Michigan's Consumer Sentiment Index improving more than 10% to 65.7. That was sharply higher than economists' expectations for 59. And the rebound comes as Americans are feeling a little less fearful about gas prices rising any further. Consumers seem to think we've kind of topped out on that. Sentiment about current economic conditions improved more than a point to 88.1, while expectations for the next 6 months jumped nearly 10 points to 64.1. Respondents to the survey said they do expect inflation to remain at 5.4% 1 year from now and 3% 5 years from now. And as consumer sentiment improved, traders are still feeling ultra pessimistic. The American Association of Individual Investors Sentiment Survey shows sentiment about the short-term direction of the stock market is unusually low. Bullish sentiment for the next 6 months tumbled more than 7 points this week to 24.7%, and that's below the historical average of 38% for the 20th straight week. Bearish sentiment, meantime, jumped nearly 14 points to 41.4%, and that's above the historical average for the 19th time out of the last 20 weeks. Inflation remained the top reason for that negative sentiment, followed by the war in Ukraine. And as we wrap up things for today, I do want to give you a quick heads up. There will be no Coffee with Greta newsletter tomorrow and also no Wall Report. The market is closed in observance of Good Friday. So if you have the day off, enjoy your long weekend. And if you don't, at least it's Friday. I'll see you all back here next week. Be sure to give this video a like before you go.